I talked about dividends a little bit, right? But I didn't talk about the different types of dividends you might have or how to allocate dividends between preferred stock and common stock. That's what we want to do this time, okay? And the author talks about it, but I'm going to add one to it, okay? So if you think about preferred stock and common stock, okay? What do they mean by preferred and common stock? What are differences between preferred and common stock? I'm not sure preferred is really preferred. It's just different, right? Sometimes it's a preference, sometimes it's a disadvantage. What are differences?
Like preferred, you don't have a voting right.
Yeah, so this votes. This is non-voting. That's the big difference.
And you get paid for stuff voted too.
Yeah, so that is a preference. Non-voting, I think, is a disadvantage, don't you? Yeah. But it could be voting. You can make preferred stock be anything you want. It's extremely flexible. So if you make it voting, what do you bet you want more money for? Yeah, so if you want preferred stock that votes, you have to pay more for it, right? Because you get more, right? You get some control. Okay. So common stock's always voting. Preferred stock typically is not. Okay, what else we got? What did you say? Preferred dividend?
Yeah, you get dividends first.
Yeah, they get their first dividend, so it's like 5% dividend or 4% dividend of the par value, or it's just stated amount each year, $2 a share or $5 or whatever it is. Okay, so they get their dividends first. Okay, that's true. Okay, and these guys just get whatever left over, typically. Okay, that's one way. What else we got? What other preferences can you have? They get the first dividend, but also they might all be able to accumulate. So we can have cumulative, and we'll get into what that is in a few minutes. Cumulative versus non-cumulative, okay? Cumulative is, if I don't get a dividend 1 year, the next year I'll get 2 years dividends. Wow, if I'm preferred stock, right? If they don't pay dividends for 10 years, in the 11th year I'll get 11 years dividends. Before what? Before common get anything, right? So what would you rather have, cumulative or non-cumulative? If you're preferred shareholder. Cumulative, of course, right? Because if years are skipped, you still get the dividend. This is not like interest, right? Interest accumulates, and there's interest on the interest on debt. This is a dividend. You can pay them or not, right? You don't have to give dividends. But if you do, preferred shareholders get theirs first. Everybody got the idea? And if it's cumulative, if you do, you have to give them all the years you didn't pay them a dividend, right? So it makes it more like debt, doesn't it? If it's non-voting, right, cumulative, that sounds more like debt. If it's voting, non-cumulative, that sounds more like equity, right? So it's kind of in between stuff. It is equity. Preferred stock is equity, but I think they're preferred shareholders. They're taking some of the risk of the business. Okay. All right. So what else is there?
There's a set dividend, right? For preferred.
Yeah, it'd be a certain percentage. They get the first dividend, and it's a certain percentage, and there is none on the common. That's absolutely true. Yes. And
I have a question. So when they take money from these to pay out, like, does it always come from retained earnings?
yeah,
Okay.
all the dividends
And
from
it
retained
goes
earnings.
from retained
So it's
earnings.
always debit retained earnings, debit dividends, then close that to retained.
So does it go like, so it comes from retained earnings and it goes to common stock for common stock, and then it goes to preferred?
No, it'd be dividends payable.
Okay.
This is cash dividend.
I think in the book, oh, okay.
Yeah,
Was
no,
that
the
for
stock dividend? Stock dividend goes to common stock or preferred stock.
Okay,
We
so
don't
okay.
We don't usually do preferred stock dividends.
Okay.
That's not
So for
at all
cash, it's
common.
always
Yeah, it's cash.
Okay.
This could be cash.
cash and a
Dividend payable and then cash later.
Okay.
Right?
Okay.
Yeah. Journal entry would be what? If you declare a dividend, what do you do? This is on the quiz. I just did it last night or this morning. What do you think?
Debit retained earnings.
Debit retained earnings or dividends, which you're going to close to retained earnings and credit.
Dividends payable.
Dividends payable. That's on the date you declared it, right? Then on the date of record, you find out who owns the shares, right? Who you're going to write the checks to. They know journal entry. And then the date of payment,
Correct. Dividends payable.
debit dividends payable, getting rid of it, and credit cash. Simple, isn't it? There's just nothing to this. Okay? All right, good. So yeah, that's what this is. We're just coming up with how much goes to who.
Okay.
What this is about. Okay, cool. All right, and there's no such thing as cumulative, of course, for common shareholders. Okay, but what else is there? How about in liquidation? These guys get a liquidation preference.
Usually like a percentage or something?
Yeah, they might get 105% of its par value or something.
Yeah.
So that's a preference too. I think that's a preference. If they close down the business, they get paid before the common shareholders. But if you declare bankruptcy, who gets paid? Who gets paid first?
Okay.
Employees. Then Back wages and stuff, you gotta pay all that first, or stealing from them. Then who gets paid? No, government, taxes. Then who gets paid? It's liabilities, but which ones? No, not accounts payable. Secured creditors, bonds, they're secured, they get first priority. Mortgages, they're secured, they have property secured, right, collateral. So secured creditors first, then unsecured, down where you get accounts payable, things like that, right? Unsecured, right? And then what? Preferred shareholders, and then who? Common. Who's taking the biggest risk? Common. Who wants the biggest return? Expected return. Take more risk, what do you want? More return, of course. Preferred shareholders get a lower return than common typically. That makes sense? But they might get a better return than debt holders, right? Because they're taking more risk.
Now, is preferred usually like more expensive?
No. It's just whatever it is, whatever the value
Is
is.
there less of it or more of it?
Usually it has a higher par value and therefore the stock is sold for more, but that means nothing. It's how much you earn, what percentage you earn, right?
Okay.
If I invest $10 a share in common stock and it pays $2 dividend, that's 20%, right?
So why choose common
Or
over
increases.
preferred then?
Oh, because you get to vote. Because any excess earnings you get, you're taking more risk, but you get more return.
Okay.
That's why control, right? More return. Why would you issue preferred? Because remember, the common shareholders are the ones that issue the preferred stock. They vote to do it or not, right? Why would you do it? You want their money, but you don't want to give them a vote. You're non-voting preferred stock, right? Why would you buy preferred stock? It's a really good company, and you want to be in there, right? Okay, yeah.
Is there any rule like, stock memorial, like, do they have to have common stock or preferred stock?
Oh, you have to have common or you're not a corporation.
Okay.
Voting stock, right? The common is always there. You don't have to prefer to no money. So a lot of companies have no preferred stock. Yeah, good question. Okay, so this is liquidation preference, and of course common shareholders don't have that. They just get whatever's left over when they're done. Okay, they split among their shares. What else is there? It could be callable. But you know what? Callable makes it more like debt. Because what it means is the common shareholders can call it if they want. They can buy it back at a set price, usually higher than the par value, right? It's kind of like liquidation, only you don't liquidate. You just buy it because you feel like it, okay? Then we have convertibles. There's all kinds of things on this. See, this is real flexible stuff, isn't it? Convertibles get a little more like equity because it's convertible into common stock. You look at the bonds can be convertible into common stock too, can't they? At whose option? That's at the option of the holder of the bond or the holder of the preferred stock, right? Whoever has that asset, right? They can convert it if they want into common stock. One of the ways you might convince them to buy your preferred stock is to make it convertible. So then they have dividend first, right? They like that. You give them cumulative dividends too. They like that. You need the money, right? And then you give them convertible. So if the company takes off and starts making a whole bunch of money, when it's better for them, they can switch to common. And now they have a vote and they share in the earnings. Got the idea? Yeah.
So is preferred the only one? Is the preferred the kind that becomes, is it treasury stock or something?
No, typically the treasury stock would be common. Buying back.
But isn't that when they recall it? Will they buy it back?
Well, no, that's not recalling. The callable is just I can buy it whenever I feel like it.
Okay.
Directly from you. If you have the stock, I can buy it from you.
Okay.
A lot of times preferred stock is not publicly traded.
Okay.
Common is typically for a life corporation.
Okay.
Preferred doesn't have to be. Right? It doesn't matter. Okay, it makes sense.
But then treasury always comes from common?
Yeah.
Okay.
Yeah. Okay. I guess you could buy back preferred stock if you want, right? But
Yeah.
usually you're buying it back to retire it.
Okay.
By the way, you can buy that common stock as treasury stock. You retire that too if you want. We'll do that in a later class. Okay, it's no big deal. You just eliminate the equity. All right. Let's see what else is there. Oh, I mentioned cumulative. There's another one. Participating or not. And this one, and we're going to do an example of this. We're going to do an example of the cumulative and the participating. Okay. Because it makes a difference in the dividends. This, the idea of participating is after after the preferred shareholders get their dividend for the current year and any prior year dividends that you passed if it's cumulative. By the way, those are called dividends in arrears. They're behind, right? Dividends in arrears. So if I haven't paid a dividend for 3 years, those 3 years would be dividends in arrears, and then the current year would be the current year dividends. You give them 4 years dividend, right? If it was cumulative. We'll do an example of that. Anyway, what participating is after the preferred shareholders get their dividend for the current year and any dividends in arrears that's cumulative, then you give the common shareholders a matching dividend to match theirs, right? Not exactly the same amount, but whatever the agreement says, right? A matching dividend. And then after that you participate, and you usually participate based on relative par values. That's not in the book, I'll show you that. You know how I like to always show you something else, just give you more than your money's worth. And you really appreciate it, right? It's nice, especially when it shows up on a quiz, right? No fun?
The best.
The best, good, yeah. Remember when you go to work, that's what you like. I'm going to give you even more responsibility. Oh, boy, wonderful, yeah. More hours to work, I love it, yeah. Show up with your paycheck, sorry. You take it, right? It's okay. Would you mind doing, that's sort of a, actually, any time in your career, would you mind taking this on? What are you going to say? Yeah. Unless you're in your last year, then you might say, hell no, I'm not doing anything else. Right? But, you know, up until then, yeah, the dean just asked me to do something a few weeks ago. Oh, really, Robert? I'm to the point where to do that, right? Oh, come on, Keith. Would you? Yeah, come on. Okay, fine. Go to the institution, all that stuff. Almost no money. Almost none. Yeah, so you keep doing it. I don't know why at this point. Okay, no, I'm kidding. All right. Good thing to do. Good thing to do all through your career. Do your part. Okay, anyway, so none of these things apply over here, right, guys? None of them apply to them. Okay, so let's do an example of this. Any questions about any of that so far? So could you make this stuff kind of like debt? Let's go back to that. What would be kind of like debt? Non-voting, right? They always have the first dividend. Cumulative, right? A nice liquidation preference. Neither one of those probably, convertible or callable, probably doesn't matter. And non-participating, right? That's kind of like that, right? If you don't pay the interest, you get the interest still. Well, if you don't pay the dividend, you get the dividend still, right? Okay, what's more like equity? Voting, right? Non-cumulative and participating, huh? Could be more like that. So you can structure this to be anything you want. Kind of cool, huh? So preferred stock's really neat. It's kind of somewhere in between debt and equity, really. But it's equity. Oh, by the way, let's issue some stock. Let's say it's got a $100 par, and we issue it for cash. And we get $120, one share. Give me the journal entry. We get $120 cash. And we issue them one share, preferred stock, par value $100. Debit what? Don't think about this too much. Debit what, guys? Come on. This is easy chapter stuff to think, right? Debit what? You've got 120 cash from somebody. Are you guys out there today? Debit cash, 120, right? You received cash from the shareholder, 120. You gave him a share of stock. How do you always record the stock, whether it's preferred or common? That is par value. I said the par is 100. Okay? What's that? Don't call it common stock. What do you want to call it? Cleverly, preferred stock, because that's what it is. Okay? That's where it comes from. So they're at par too, just like the common was last time we were together, right? You guys are too excited. Okay, and then what? These are going to be the free points on the quiz. You want to get these. Okay, then what? What's the component called? What do you call this? You know, capital that was paid in addition. Yeah, additional paid in capital on preferred stock. You guys are really asleep today. Okay, got it? What if it was land we got? Then debit land. What if it was an inventory? Then debit inventory, just like common stock, right? Everybody good with this? No big deal? Don't you hope I can do that? Probably will in some fashion. Preferred stock, common stock, both. Maybe. All right, so let's do an example. And now you'll have to start thinking a little bit, you guys. Let's say that I have preferred stock and common stock. Okay, and let's leave a little room. Let's say I have preferred stock authorized 100,000 shares issued and outstanding. That means I didn't buy any back, right? 10,000 shares. Par. Par stated value, depending on the state, $100. Okay. Common stock. Authorized. $1 million shares. Outstanding. Whoops, issued first. Issued. Let's do $910,000 shares. Okay. Treasury stock, 10,000 shares. You know where I'm going with this, don't you? Outstanding, how many? You know, you issued 910 and you bought back 10 when you're out there. 900,000 shares. Okay. Okay. So when I pay dividends, who am I going to pay dividends to? The 10,000 preferred shareholders. They get their money first. And then what? Then all the common. Only the 900 though, not the 910, right? Because if you paid it on the 10 treasury stock, you'd be writing a check to yourself. Are you going to pay it on the 90,000 that have never been issued, the unissued ones? Of course not. You'd be writing a check to yourself. Everybody agree? So it's going to be on the outstanding shares. Okay? All right. So it's going to be issued, and these are the outstanding ones here, right? Issued and outstanding both. Okay? So then, what we do is, we need a par here, I guess, too. Or, yeah, need a par here. We're going to need a par. Okay? And let's make the par be, see, what's 100 times 10,000? Is that $1 million? Let's make this be $10. What would that be? 9 million? Okay, yeah. All right. What is the total par for the stock that's outstanding? What's the total par here? We're going to use this later when we do participating. That's 9 million, right, guys? What's the total par here? 10,000 times 100 is what? 10 million? It is, isn't it? So what's the total par I have for the whole company? This is the par for the preferred stock, right? This is the par for the common stock. Preferred stock, common stock. Sure. So, you know, is that 10 million or 1 million? It's 1 million. Come on, Keith. That's what I wanted it to be too. Somebody with a calculator. Sure, I got the decimal right close. I think I do. 10,000 times 100. Move it over 2 places. Yeah, it's 1 million. Okay. So I've got $1 million here, right? And I've got 9 million here. True? Looks like 10% of the total par is in preferred stock. Everybody agree with that? That's 10% of the total of the two added together. And this one is 90%. Everybody see what I just did? So if I share dividends based on relative par values, what am I going to do? Give 10% to preferred shareholders and give 90% to the common shareholders, huh? Based on their relative par values. That's all the same. Okay? All right. So now, what are we going to do? Tell me, one other thing. Let's say that this is I don't know, it's a 4% annual dividend. What does that mean? It's 4% of the $100 par, isn't it? Right? So what is that going to be for every share every year? If they get a dividend, they get what? You don't have to declare dividends, but if you do, what do they get first? $4 on each share. Everybody agree? Okay, that's $4. How many shares are outstanding? So how many dollars is that? 10,000 times $4. How much is that? 40,000. $40,000 dividend. That's first for the preferred shareholders. Right? Would everybody agree to that? The first 40,000, no matter how much you declare, the first 40,000 goes to preferred shareholders. What if you only declare 25,000? They get it all. Got it? What if you declare 41,000? Well, they get the first 40, and then you have to decide what you're going to do with the other one. depending on what kind of stock it is. Got the idea? What if you do $500,000? They get the first 40,000. You got to decide what you're going to do with the rest. Got the idea? They get the first 40. Okay? Okay, so then there's different types of stocks. So let's do all of these. First one is, what if it is non-cumulative? That means if you pass dividends in one year, you don't have dividends, they don't get it in future years. They just get the current year dividend is all they'll ever get, right? Got the idea? Non-cumulative, non-participating. That means after they get their dividend, they don't get to share in any earnings over that, okay? And it's out of luck after that, okay? That's one. B is cumulative. These are real predictable, non-participating. What this is if I have dividends that have not been paid for a while, then I'm going to get those dividends in arrears. And let's say there's been no dividends for 2 years, not including the current year. So that would be 2 years in arrears, we'd say. So 2 years in arrears. So what happens if it's cumulative? Preferred shareholders get the current year plus 2 prior years. It's 40,000 for each year, so what would they get first? 120. Right? They get 120. Everybody good? They get 40 for each year. 2 years and 80 for the prior years, and then 40 for the current year, right? 120. Okay, fine. So we got cumulative non-participating. This is real predictable. How about if we then do non-cumulative with participating? Okay? And then guess what the last one's going to be? Cumulative and participating. It's both. So I want you to be able to handle all 4 of those. It's just not that big a deal. Okay, let's decide on an amount for a dividend. Okay? So if I have 120 going for them anyway. Let's say it's, I need one other thing. If they are going to participate, when I got down here for the last 2 that are participating, if they are going to participate, we need a matching dividend for the preferred shareholders. So let's say, how many shares do we have? 900,000. Let's say the matching, if it is participating, the matching, it's going to be 10 cents per share. Okay? 10 cents per share. There's 900,000 shares, so how much is that going to be? 90,000. Everybody agree? 900,000 shares outstanding, so that'd be 90,000. So they get 90,000. Okay? Okay? Yes, sir.
What's it say in the parentheses?
In arrears. Behind, in arrears. In the rear. Got it? In arrears. Okay? And so let's give these a shot. This is really, really simple, particularly the first 2 are really simple. Okay, what we're going to do is we're going to give preferred shareholders their money first. And then second, we're going to give common shareholders their money. That'll always be true. And then there might be more if you're participating, but that's all there's going to be here. So let's say our dividends for all these, let's say our dividends this year are $500,000, okay? So you tell me, if we declare dividends of $500,000, what's the journal entry? Debit what? Retainers. Credit. Dividends paid. That's it. Okay, and then we'll decide who we're going to write the checks to. That's on the data record, right? That's the data declaration. On the data record, no journal entry. We just decide who we're going to write the checks to. Right? Here, what we're going to do here is decide how much goes to preferred shareholders, how much goes to common. Once you know what preferred shareholders get per share, you take a times the number of shares. That's what their check's going to be, right? Common shareholders take the common dividend per share times their number of shares each, right? That's how much you send to them. Big deal. And then what are you going to do on the data payment? Credit, debit, dividends payable, credit, cash. This is easy, isn't it? Okay? So, and this isn't too bad either, even computing the amount. So what we're going to do is in total and per share. Okay, so how much is the total that we're going to do, you guys? Let's say $500,000. Okay, so let's say it's $500,000. How are we going to split it up? This is going to be the total. And then we'll do per share too, huh? Per share is pretty easy. What do you think it is? I'm going to split that 500 up. Yeah, what's the first thing that happens? Preferred shareholders, it's non-cumulative, non-participating. We don't care about the dividends and arrears. There's no such thing with non-cumulative, right? You pass a year's dividend, you just lose it. So what's it going to be? How much? 40,000. I'm going to give the preferred shareholders 40,000. And how much is left? 460. Who gets that? Common shareholders. Yeah, I can't believe that, but that's it. Okay, there's just nothing to this. Okay, so per share, what is it? This is $4. We already knew that. There's 10,000 shares times $4. That's how we got the 40, right? So what would it be for common? I'll have to calculate that one. What do you do? 900,000 outstanding shares divided into 460, right? How much is that? What do they get per share? 196. Okay. Ta-da. That's it. We're done. Okay. All right. Let's do cumulative non-participating. This one's real easy too.
What number did you say you? What did you say you divided? 900,000.
By the 900,000 outstanding shares
Divided by what?
into the 460.
Okay.
Right. I'm going to give them 460,000. I just want to know how much each share gets. Divide the shares in. 900 into 460 is about 96. So if I own 10 shares, I'd get $19.60. Get the idea? We'll take it times. Good. Easy. Okay. So let's do cumulative non-participating. And it's still 500,000. Let's say it's still a 500,000 dividend. First, second, go, right? How much you're going to give to the common shareholders, how much you're going to give to the preferred shareholders, and how much you're going to give to the common shareholders. Preferred's always first, right? They're preferred. Okay, in that sense they are. How much the preferred shareholders get this time versus the common shareholders? Well, what do? We are going to give them the current year and what? 2 years in arrears. Yeah, so we had 2 years in arrears, right? Sometimes I'll say it's 3 years including the years in arrears. The problem will say, sometimes it'll say 2 years in arrears, right? If it's 2 years including the current year, then it's only 1 in arrears. Read carefully, right? See, it's pretty clear, okay? But read it carefully, so because how the problem's worded. Okay, so anyway, what are they going to do? How much do they get? 40,000 a year for how many? 3 years. How much is that? 120,000. Good. What's the total? And you're going to give everything else to the common shareholders. 380. This is a wonderful chapter. Okay, anyway, we needed something easy. Per share, how much? Was 10,000 shares divided in is $12, right? And it's $4 3 times, right? It's $12. Either way, it's $12, isn't it? Everybody agree? $12 a share? Okay, what's the common going to be? 380 divided by 900,000 shares. How much is that? 42 cents. 42 cents. Okay, 0.42. Everybody good? 460, that wasn't right. It's not $1.96. Where'd you guys get $1.96? 460 divided by 900 is more like 50 cents. How much is that?
51 cents.
51 cents. Nobody noticed that? Just left us hanging out there. Okay, so it's 51 cents here approximately, right? And this one's 42 cents, right? Wow. Okay, anyway, I don't know what happened there. Okay, all right? Yes.
Is it the number of shares divided by the total, or is it the dollar amount divided by the share?
It's per share. Okay, here's what's happening. We are giving them $460,000. There are 900,000 shares. What are you going to pay per share? 460 divided by 900. Is that what happened? We divided it backwards?
Yeah.
Yeah. That makes absolutely no sense. Am I right? Yeah. I don't know what that number would mean. Right? Okay. Anyway, you guys really have checked out today, haven't you? Yeah. Pretty good. Pretty good. I'm pretty bad too. That's because this is too easy. Is that it? It might be true, huh? It's not very challenging, so then we don't learn it at all. No, let's not do that. Right? Learn it. I'll actually give you points for doing this stuff, okay? Give these, because you got to see the bond problem I wrote for you. Oh, it's really cool. Yeah, it's really a fun one. So, it's just long, that's all. It's predictable. Okay, how about non-cumulative participating? Now, this gets a little different, huh? because what we're gonna have to do is participate now, okay? So now it's 3-stage. So what happens? First, what happens? The preferred shareholders get what? This is non-cumulative, so what do they get first? They get the first 40,000 in current year dividend. You guys agree with that? Okay? And then second, what happens? Common shareholders, they don't get what's left. What do they get? A matching dividend. And by the way, there's no such thing as matching dividends in arrears, right? You just get the matching dividend for the current year. How much did we say the matching dividend was? I just made up a number. I said it was 10 cents per share, right? They match after the common share, or the preferred shareholders get theirs. Common shareholders get 10 cents a share, and then they're going to share after that. They're going to participate after that. Okay? Whatever you write in the agreement. So it's 10 cents a share on the 900,000 shares, and how much did we say that was? 90,000. So the next 90,000 goes to the common shareholders. So what are we up to now, you guys? 40 for the preferred, then 90 for the common. So we're up to, we've allocated 130. We don't write checks yet, of course. We're just going to write them one check. Okay, so 130. So how much do we have left to make our whole 500,000? So that's going to be the total, right? Everybody agree? See what we're doing? So the total is going to be $500,000. Well, how much is left to make 500 if I allocated 130 of it? 370, is that right? Okay. Now, does everybody see where I got the 130? 40 for the current year, and then 10 cents a share on the 900,000 shares, or 90,000 for a matching dividend. Okay? Whatever the matching dividend is, huh? Okay? So I've given away 130, or plan to give away 130, so there's 500 total, so there's 370 left. How are you going to split the 370? What did we say we were going to do? I have par value on the preferred stock, how much? 10,000 shares at $100. So what's 10,000 times $100? 1 million. Everybody agree? Ah, and then the same thing for the common. 900,000 times $10 is 9 million, right? So what's a million plus 9 million? I made the math easy. 10 million. So 1 million is 10% of it, right? For the preferred shareholders. 9 million is 90% for the common shareholders. Of course, the math doesn't have to work out that nice, but you got the idea? Everybody got it? It's just relative par values, okay? It's real common to do it that way, okay? More common than other ways. You can write these agreements any way you want, of course, right? But it's business deals, so you can write anything you want. So what I'm going to do is I'm going to give 10% then to who? This is the third thing I'm going to do. Last thing. Anything that's left. Preferred shareholders get what? 10%, $37,000. Okay? That's 10%. What's the common shareholders going to get? The 90% in this case. How much is that? 332? 370 times 332 was it? 90% of 370. 333. Is that right? 333,000. Because it's got to be 37 plus 333 is the 370, right? Everybody good? That's 90%. So then how much in total are we giving each group? And it's got to add up to the 500, so we'll check our math. 40, right? Plus 37 for the preferred, what do they get? 77,000. Common, 90 plus 333, how much is that? 423. Make sure that 77 plus 423 is 500. We got it, don't we? We're in great shape. Everybody good? Okay, so let's do per share now. What would you do for per share? They told me in the other class that my H's look like L's. Share looks like straight line or something. Yeah. Boy, if you weren't paying attention, you'd be in big trouble, wouldn't you? Straight line dividends. They don't do that. Okay, anyway. Yeah, they do kind of. All right, so what would you do here? Divide the shares in. How many shares are there in preferred? My simple little example. I had 10,000, didn't I? 10,000 into 77,000 is what? 770 per share. True? Well, yeah, it's $4 for the current year, right? plus it looks like 37,000 divided by 10,000 is 370. So 4 and 370 is a 770, isn't it? Easy? What's common going to be? It's 90,000 shares, right? So 423,000 divided by 90,000, how much is that? Oh, it's 900,000. Sorry, not 90,000. $90,000 was it? It's 900,000 shares. You're absolutely right. Not 900,000. What do you get? 47 cents about. Okay. Got it. So guess what cumulative participating is going to do? It's very logical. What are you going to do first, everybody? Preferred shareholders, but this time they don't get 40. What do they get? It's cumulative. 2 years in arrears plus the current year, 120. That goes first. Second, keep them in order. You got it made. Common shareholders get their matching, right? How much is the matching? 10 cents a share, 900,000 shares was 90,000. How much have we given away so far, we think? 210. How much is left to make the 500 total we had? Going to be 500, right? 290's left. Good. And we're going to split that, right? Okay, how are we going to split it? It's the third thing we do. 10% for preferred shareholders, right guys? How much is that? I made my math really nice and easy, didn't I? I'm still struggling. That's 29,000, right? And then the 90% is going to go to the common shareholders, right? How much is that? 261, is that what that is? 290 less 629. 261,000. And we just add them up. For the preferred shareholders, it's 120 plus 29 is 149, is that right? For the common shareholders, 90 plus 261, what's that? Okay. Everybody good? That's the total. So I'll ask you for that. Then I'll ask you for per share on all of them. How many shares were there of the preferred stock? 10,000, 149,000, 10,000. What is it? $14.90. Is that what that is? True? It's $12 for the current year dividend and 2 in arrears, plus $2.90 a share, right, for participating. What are the common shareholders going to get? 351,000 divided by 900,000 shares, right, Pete? How much is that? 39 cents. Ta-da. Done? You guys can do this, can't you? So, you know, practice. One on the quiz that does stuff like this. Okay? All right. Any questions about any of that? Okay. Simple. Nice, easy chapter. That'll be okay. We'll make up for it in the next one. I promise. In the bonds kind of was. Thank you. Let's do another thing. One of the things they didn't do in bonds is, what if we retire bonds? Think about this. When would you retire bonds?
When they run out of time.
Well, at maturity, you retire them, but then there's no gain or loss on that. You just pay them off. So that's just paying to the maturity date. Yeah, but that's retirement. Okay, but could you retire them earlier? Yeah. When would you do that? Yeah, that's it. Well, no, you're buying them. Your bonds. If you have investment in bonds, you can sell them, but that's not really retiring. The bond still exists. Somebody else has it, right? But no, I owe the money on the bond.
We're not bankruptcy.
Oh, well, I might discharge it in bankruptcy, but that's a whole different issue. We don't want to go there. Okay, that county gets kind of a mess. Okay. But, yeah, we don't want it. But, might you ever go out in the market and buy your own bonds?
Still like a bond contributing capital in line.
Well, yeah, you got some more contributed capital in and you go retire the debt. Can you retire debt? Sure, you just pay it off. And the nice thing with bonds is you can go out in the market and buy them, right? Or they can be callable bonds and you have the right to buy them whenever you want, right? You read about that too, right? There's all kinds of provisions in the bonds. You can write or design those any way you want to. So you might go out and get them, right? Go get them. You're tired of paying the interest and you have the cash. What's really awful about this, though, is bonds change in value, don't they? When? When interest rates go up, what happens to the value of any bond? It goes down. Oh. So I could retire it with a gain because it goes down in value, even though interest rates went up. Listen to this one carefully. That's a good idea, by the way. If you have excess cash, you could do that, couldn't you? But here, interest rates go up, right? So the value of the bond goes down. People sometimes borrow money at higher interest rates, take the money and go retire a bond where they're paying lower interest rates. The reason they do it is to get a gain on their income statement. Those of us who know what we're doing, what do we think about that? Borrow money at a higher interest rate to get an artificial gain on your financial statement. What do you think? You're throwing my wealth away to make it look better. So this is this weird thing in accounting where a gain will show up because you made a ridiculous decision. Right? It's not a real gain. The loss isn't real either. If you have a loss, why would you end up with a loss? Because interest rates went down, the value of the bond goes up, you retire it because you have excess cash, you have a loss. It's not really a loss, it's a good business decision, right? There's nothing we can do about this because it's the book value compared to whatever tax we paid for it. It used to be that those gains or losses were considered extraordinary items. They are not anymore. They used to be considered extraordinary items. For a long time ago, we just decided not to do that anymore, the profession did, right? It's really man-made, so it's not an extraordinary item. But the reason they wanted to show them as extraordinary items is to stop people from doing that, creating this artificial gain. So let me show you how this would work. I might have you do one of these, okay? Might have to do this. And if I do, you should celebrate. It's really simple. Let's say I have a bond payable. It's $100,000. We'll make the math easy. Bond payable is $100,000. Okay. And let's say we have a discount. And a premium would work the same way. You just have another credit, right? Premium. Discount on bonds payable. And let's say our discount is, I don't know, $6,000, okay? So what's my carrying value of this bond? $94,000. If I pay more than $94,000 to retire it, I will have a loss. If I pay less than $94,000 to retire it, I will have a gain. At $94,000, I'll break even, huh? So let's do these three. You guys already know this because you know how to record selling equipment or selling facility. It's going to be sort of the same thing. You can buy and sell debt. Weird, but you can't, right? We sell our debt when we borrow money, right? Okay, and we can buy it back. That's retiring. Okay? So yeah. So let's say I do it for $94,000 cash. These are all cash. Okay? $94,000 cash is what I paid. B will be, I don't know, $97,000 cash. C will be, I don't know, $92,000 cash. Write those three journal entries. Can you do that? Real quick. That's pretty easy. What are the debits, guys? Cash, cash, cash. Okay. What are the credits? Bond payable, bond payable, bond payable. What else do you need to get rid of? Discount, discount, discount. That's going to be another credit. Sure. And any difference that's left is the gain or the loss. That's it. That's it. Bet you can do that. Just counting how many people are here. What happened to us? Same thing happens at work in competitive environments. It's not even mean. It's just not. People who deliver stick around. People who don't. I don't think it's mean. Maybe do something they like, right? Use a different way. Where they'll work. What are you going to debit cash for in the first one? 94. What are you going to debit cash for in the second? 97. You guys have this in your paper? 92. What are you going to credit? What you get rid of? Bond payable. How much? 100. Bond payable. Not 94. It is going to be 94 net, but you got to get rid of the discount too, right? Two different accounts. Okay, so the carrying amount is 94, yes. Okay, now I get it, so this is gone, right? Now I get rid of this one, don't I? Just like accumulated depreciation, if you're getting rid of a building or a piece of equipment, you better get rid of the discount of the premium, right? You don't have a bond anymore. Okay, so what would that be? Debit the discount from bonds payable for 6, and that one there's no gain or loss, right? We're done. Okay, you retired it for its face value, or I'm sorry, for its carrying value, for its book value. Okay, this would be what? Debit the discount for how much? 6. What else do I need? That's 103. The bond payable is only 100. So what do I have? 3. Gain on retirement. So I get this gain on retirement. But is it really a gain? The reason I retired it for 97 is what? Interest rates did what? The bond value went down, so interest rates must have gone up. So if I had excess cash and I did this, fine. That's a nice deal. What if I don't have excess cash? You know, like you said, more contributed capital, right? Or more earnings retained from earning, right? That might be a good idea, huh? But what if I went and borrowed the money at a higher interest rate, did this? That's kind of insane, isn't it? You're going to pay more interest in the future to get a gain now that's not even really a gain? Wouldn't that have been better off to keep paying the lower interest rate? Yes, of course. Okay, so this is a strange one. And then on the last one, what is it? Discount on bonds payable is, what was it, 6? That's 98. I need another 2. What is it, guys? Loss on retirement. Is it a real loss? Well, kinda. I have to reflect the loss to my debits to my credits, don't I? But probably what happened was interest rates went down, right? And I could borrow money cheaper and pay this thing off. But I lost on paying it off, although I had to give cash to pay it off too, right? And if I had new investors, I had more money come in, or I had some profits, I'd still want to pay it off, right? In fact, I have a gain or loss. Yeah.
So are we buying new bonds back or calling them back?
I'm buying it back.
Why are we debiting cash then?
Why did I debit cash? I put them all backwards. Geez, no wonder. Anybody else notice that was backwards? Like everybody? Why don't you finally say thank you for saying something? Man, the brain's not working. It just can't be. He seems so confident. What do I have to do? I've got to debit the bond payable. Jeez. Okay. What do I have to do? Debit the bond payable. Did I say it right and wrote it wrong? I did say it right there. Okay, and then I've got to credit the discount, don't I? I think I did the other class right. I sure hope so. Okay, then what? How much was cash? 94. Thank you. Look a little better? Yeah, thanks. Okay, how about this one? Same thing. Bond payable, 100. Criticize you guys for not thinking when it gets easy. And I do the same thing. Then what? Discounted bonds payable? How much is that? 6. And I need a 3 what? I gave 97 for a $94,000 bond. That's the loss of bond payable, right? On retirement. Okay, and then this one, we have the bond payable for the 100. Credit cash for how much this time? $92. Credit the discount. This one will give you a gain. Did I even have a gain in the right place? 6. Had to call them backwards. The 2 gain. Gain. Okay. Cross off all that other stuff. Thank you. Okay? It's simple. It's too simple, I guess. Take a 5-minute break. You're going to stick around. If not, study. See you later. Watch the review session or watch one of the earlier ones. I think they're out there, aren't they? Is there one out there? Anybody look yet? Covering this stuff?